In both real estate and business, you take the income generated, the EBITDA in business, and you multiply it. But that's where, let's say, a property is generating 300,000 a year. Maybe you're multiplying that by 8 and you're talking a 2.4, $2.5 million value for that property. For a business, that same 300,000, let's say, is 3 to 5. So you're at $1 million to $1.5 million in value, because the one thing we can't sell is the executive and management ability of ownership. The new owner is going to be better or worse than the old owner. They won't be exactly the same, and they could excel as the new owner, and it could end up being a value proposition at the price they bought 5 years later. They also could drive it into a wall and kill the business, which we've all seen, where a business we like changes ownership and product quality, customer service decline, employees migrate away, and it doesn't survive.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Gregory Kovsky. Gregory is the president and CEO of a regional business brokerage and commercial real estate firm called International Business Associate. And in just a minute, we're going to speak with Gregory Kovsky about why it is prudent to have a real estate licensed merger and acquisition broker facilitate the sale of your business. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe, and as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Gregory Kovsky. Welcome to CREPN Radio.
It's an honor to be here, Darren. Thank you.
Well, I'm glad you're here, and I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Certainly. I'm a Portland boy. Grew up in the great state of Oregon, left, spread my wings and flew and went to the University of Texas, pursued my first career after getting a degree in investment finance and accounting, missed the Northwest and returned in 94, joined IBA as a business broker and commercial realtor, working for the founder of the firm, and emerged as one of the top salesmen with the company. Succeeded him as owner in 2000 with a internal acquisition of the company. And 26 years later, I'm still running the firm with 10 offices spread throughout Oregon and Washington.
Awesome. Well, that's kind of an interesting turn of events. You go from selling businesses to applying your skills to buying the business you're a part of.
Exactly. No, I was a bit of a favored son and had been mentored by a wonderful individual, Bill Osofsky, and he was looking to retire, and we didn't want to disrupt the ecosystem for the staff because many of them were approaching retirement, had kids in college, and like any real estate company, they could go to the Four Corners if they didn't like the transition. So often in the real estate world, it makes sense to do an internal transition to maintain team chemistry and continuity.
Yeah. No, that's I'm happy to hear that. I know a lot of times in current days it's not always the case, but an internal transition's nice. So I want to I guess start by asking you a question. We mentioned that you're a commercial real estate broker, but also kind of the business broker. Can you kind of describe and compare the difference between the two, between real estate and an operating business?
Certainly. So they're two different asset classes with different return on investment portfolios. Commercial real estate is more asset based, but obviously the income generated by commercial real estate plays a role in valuation. And you can see cap rates in that situation that generate 5% to 10% throughout the Northwest, depending on the industry segment, location, a variety of issues. In businesses, the interesting thing is the best businesses are more intangible asset than tangible asset because people buy businesses for return on investment. They buy them for appreciation ability and opportunity. And our return on investment in that space will generally start at 15%, but can go up to 50% depending on the risk of the business model. I'll give you a very classic example. On the low end of the return on investment range, the 15%, you have a gas station, which is location, location, location. You don't even need to interact with employees. You can pull up, fill up your car, put your credit card in, and drive away. Maybe you go in to the convenience store. It's not going to impact your purchase whether the bathroom's clean or not. On the other side, you would have, let's say, a beauty salon where it could be beautiful with porcelain sinks and wonderful decor. But I can tell you with my wife, if her hairstylist leaves, she is more likely to ask one of her girlfriends for referral where to go than even give the new owner a chance. So transitioning a business model like that has higher risk and warrants a much higher return.
Got it. Got it. So I'm assuming the risk and return also dictate the acquisition price, the sale price.
It does. I mean, in both real estate and business, you take the income generated, the EBITDA in business, and you multiply it. But that's where, let's say, a property is generating 300,000 a year. Maybe you're multiplying that by 8 and you're talking a 2.4, $2.5 million value for that property. For a business, that same 300,000, let's say, is 3 to 5. So you're at $1 million to $1.5 million in value. Because the one thing we can't sell is the executive and management ability of ownership. The new owner is going to be better or worse than the old owner. They won't be exactly the same. And they could excel as the new owner, and it could end up being a value proposition at the price they bought 5 years later. They also could drive it into a wall and kill the business, which we've all seen where a business we like changes ownership and product quality, customer service decline, employees migrate away, and it doesn't survive.
Yeah. No, that's true. So you mentioned a couple of examples, the hair salon uh, versus the other. I can't remember what was the first one you
Gas
mentioned.
station.
Gas station, yeah. So those are like two examples of types of businesses. Is there any type of business that you don't sell or you wouldn't sell?
We actually represent about 20 different verticals as a firm. We do a lot of manufacturing, industrial, construction, education, technology, auto and transportation, retail, hospitality, etc. We, as a firm, don't do a lot of like law practices, CPA practices. Those are areas where IBA as a firm doesn't do a lot of transactions.
Got it. And you mentioned the territory, Oregon and Washington. That's where your focus primarily. Is that correct?
Yeah, 90% of our transactions are in those two states. I would include in that Idaho and Alaska. We are active in the marine industry, so the Alaska fishing industry, we have sold a number of companies in. And then, like in Idaho right now, we're representing a custom home builder.
Got it. And as far as the size of the businesses that you represent, is there a range you can identify that's kind of your sweet spot?
We actually cover quite a range. We want a business where the owner is working on the business than in the business. So we don't want a buy a job situation where a person is working 70 hours a week to earn 85,000 a year. It's not what we do. There is market for those. So we generally start at about 150,000 in owner income. Excuse me, or approximately a half million in enterprise value. And then we go up to 5, 6 million in EBITDA, up to 25, 30 million in transaction value. So we cover quite a range with my 20 different intermediaries. I have small business specialist and then more investment banking M&A specialist.
Gotcha. And with those, is there like or I guess when you talk about the valuation there and the sales, do you ever look at like employee count as a kind of a determining factor, or is it more just sales and value?
A good question. I mean, we traditionally in screening potential clients will ask a couple questions. A, how long have you been in business? We would like a business that's been around more than 5 years. B, how many employees do you have? We would prefer double digit employees, but would consider 5 to 10 for the right business model. And then we want to know what your gross revenues are and is it a successful model? I mean, most businesses we represent, 10 to 20% falls to the bottom line after all expenses. So if you're doing $1 million in sales, you begin to get to 100 to 200,000 to ownership.
Hmm. And is that pretty uniform? I mean, that's a pretty good, I mean, an easy kind of a back of the napkin kind of a calculation if it is.
Yeah, it's a starting point. Um, we're talking commercial real estate. So if you're a brick and mortar location, you have more occupancy costs. where if it's a service model, you may be more virtual. So that can be one of the variable elements. And what are your fixed costs in terms of occupancy?
Gotcha. So for a business that's looking to be sold and a buyer that's looking to buy, for financing for these types of purchases, what percentage of these are seller carry opportunities?
For us, a very low percentage of our businesses have a large amount of seller carry. About 10% is very common. And the reason that exists is it addresses trailing liability issues that may come out of the woodwork. Obviously, the buyer doesn't want to cover elements that were associated with the previous owner's activity. Let's say we're selling a plumbing company and we do a lot in the trades. If someone a week before the sale was out doing a plumbing repair and for whatever reason they need to go back and adjust something, the new owner shouldn't have to be out of pocket for that expense because the old owner was paid for it. And so a seller note gives the buyer leverage. If the seller disappears to Jamaica and can't be found, that they can be made whole on those out of pocket expenses associated with the previous tenure of ownership. Other reasons are to make sure the seller provides the transition training consulting they agree to, that they don't put up the go on fishing sign 2 days after sale when they said, I'm going to be around for a couple months. And then also a non compete that they don't open a competitive business. But the reason we can mitigate it to 10% is America's unique with our SBA lending programs, which are very similar to the FHA type programs in residential real estate, where banks, if they lend on business acquisitions, can have 70% or more of that debt guaranteed by the government if there's a default situation, which means that if they can have someone pay for, let's say, 2 years, they're whole on their situation. And when you take 10% equity element at the start from a seller note, and let's say another 10% for a buyer capital injection, you only have the loan on 80% of the business value. And what often happens, and this may be getting the weeds a little bit, but may be of interest, we often will sell businesses where maybe it's not a right fit. I've had people leave the corporate world, say their dreams to own a business, but after 3, 5 years, they decide they like having an HR department, they like having an accounting department. They don't want to be in charge of everything. And they will turn around and sell the business. And it may not have gone up in value. It may have been about the same or even gone down. But SBA loans are 10-year term. So if you have 5 year left, even if you sold it at 80% of the value, you can retire your SBA loan, make the bank whole, and go on and do your next thing.
So I think what I understood you say is the SBA loans are they transferable? Is that
They are not,
oh they're not. Okay.
but
Okay.
they a new buyer can readily get them. It's a
Okay.
robust marketplace, and it's actually one of the most profitable lending environments for banks because they're generally getting 2 to 3% above prime, which is a pretty good return on the investment with the government guarantee.
Yeah. No, that makes sense. Um, when somebody's looking to sell, Uh, what can you describe some of the things that, or I guess what I'm trying to understand is, or I'm trying to ask, is how much preparation should one expect to invest in before they're ready to list their business or to where the financials are in good shape and all that. What kind of timeline should somebody plan on having to where their house is in order to where it's an attractive business to a buyer and also will help them get the top dollar.
Excellent question. So our process and most business brokerage processes starts with a business valuation. And that lets people learn what their business is worth today. And often our clients, which 70% are retirement sales, they will take that number to their wealth advisor and say, do I have enough to retire if I add this asset to the basket? So you need to answer that question because a business is an annuity. Let's say you're earning $1 million a year running your company. Let's say it's 10 million in revenue, 10% to the bottom line. If you need 7 million to sell, and let's say a 5% multiple is applicable, 20% return on investment, I could get 5 million for that company. You may need to run it another 2 or 3 years to get that 7 million you need to retire. So you need to know what your exit value is on that business to begin to strategically plan. And some of our clients see the value, are ready to go, and we proceed immediately down the path to sale. Others learn at time of sale how valuation models work and perhaps take actions to enhance the value. To use a residential example, people know that generally you get more bang for your buck if you update a kitchen and a bathroom in a house. So if you don't need to sell today, some people will update their countertops and cabinets to make the kitchen shine better at time of sale rather than having their 1983 kitchen, which worked fine for the family, but isn't going to resonate with the market. Um, so those type of things can be done in a business as well. Maybe you stop running personal expenses through the business. Those can cut down in profit, which using my 5 multiple, if you ran $50,000 of expenses through the business that couldn't be tracked under scrutiny, 5 times 50 is $250,000. Why not run it clean for a year and capture that?
Yeah. No, that's kind of what I was wondering, the small businesses and whether or not they have all the systems in place and are, you know, uh, I guess from an inspection standpoint, from an outsider, if they're going to attract a bigger number, or if it, or what they can do, and like you said, kind of tidy that up a little bit. That's good. Um, for a buyer, somebody that's looking to buy a business, uh, can you describe kind of some of the parameters that they should have in place or expect to be asked about when trying to buy a business?
Certainly. An interesting thing about our world is traditionally a buyer is not represented by another broker. It's a little bit of too many cooks in the kitchen for communication, and entrepreneurs generally want to control their own negotiation. They don't want to delegate it, but they are represented by a CPA who will help them with valuation and due diligence on the transaction. Due diligence being the same as a real estate inspection of property. It's bringing someone in as an expert to make sure there's no dry rot in the kid's bathroom, do the numbers work, do the bank deposits reconcile with the revenue presented, those sort of things. Then you want legal counsel to deal with trailing liability issues because it's a living and breathing thing, and you want to make sure you don't take on responsibility for what the previous owner did if they did inappropriate actions or took risks you wouldn't take. I mean, you're in the insurance business, and an interesting example I can give you is when we sell businesses, let's say it's a HVAC company with a fleet of vehicles. Most insurance policies will repair chipped, cracked windshields with minimal cost to the business owner because it's a safety issue. Well, if you do it under the existing policy, that can be done pre-sale. If they buy it as is with a cracked windshield, the new insurance company isn't as excited to pay for something that happened before they insured the party.
Yep. No, that's a good example. Definitely lean on especially the policy that you're going to be canceling anyway when the sale's complete. So that's good. That's good. Um, so in this current market cycle, we're recording this here in June of 2026. Are there any things on the horizon that uh, spell a better or a lesser opportunity as far as business transitions go right now?
Well, I think it's a robust opportunity environment with AI. I think there's automation and efficiency that is coming on the horizon, and the business owners that can take advantage of that are going to appreciate it. And what I think can happen is maybe you need less clerical staff to crunch numbers in the future, but you can transition those dollars to more business development salespeople and improve your business model because you only have so many dollars to spend on payroll. And I think the skill sets needed by businesses are going to change, but I do think it's going to create an opportunity to grow businesses and reallocate resources. I mean, think in an auto repair business, if you no longer need as big of a clerical staff and you could put another wrench into your shop, what does that do to generate more income?
Yeah. No, you've done two. You lowered your cost and increased your input there. So that's good. That's good. Um, when you compare real estate versus the business, is there a percentage number that you recognize that when you're if the seller owns the real estate, how many of those are interested in also selling the real estate versus keeping the real estate for a income stream?
Um, Probably 15-20% of our transactions include the real estate, and I'm looking forward to drilling in why there's advantages to having a business broker that also has real estate experience. Um, we always have that discussion when they own the real estate, and single occupant buildings have risk. I mean, many people thought they had a great tenant in Sears. Sears ended up not being a great tenant, and those spaces are still being filled around the nation. So, what I will often tell my clients is it may be better selling the real estate and diversifying through a 1031 exchange into maybe a less risky investment dependent on ownership. Maybe you go from owning a manufacturing real estate asset, 20,000 square feet, single occupant, and you move it into owning a couple duplexes and your risk gets diversified. Or you can go into a Delaware statutory trust or different vehicles that are more passive and less focused on one tenant. The single tenant situation sounds great until it's not.
Yeah, no, vacancy doesn't pay well. Yeah, that's true. No, that's interesting. Do you deal in franchises at all, or do you deal more in owner operators?
We definitely deal in franchises on two capacities. So we will resell franchises when, as business models, I sold an 8 location chain of Arby's for an owner up in the Seattle metropolitan area who is ready to retire. But we also uniquely at IBA have a franchise brokerage department. And so we have the ability to sell new franchises. And the nice thing about buying a new franchise versus buying an existing business is you can place it anywhere you want. So if you live in Oregon City or you live in Marysville, Washington, if your kids are in school there and you don't want a big commute, you can go through a vetted franchise list and find a business in an industry you like and locate it in your hometown and build it from there. So we often resonate with buyers with that option if they want a specific location because we can order inventory. And in some towns, let's say with under 25,000 of population, it could be years between quality opportunities coming on the market.
Yeah. No, that's true, and it's kind of nice that flexibility you mentioned. Ability to locate kind of where you are as opposed to having to relocate where an existing business is. Interesting. Hey, Gregory, if we could, I'd like to shift gears here for a second. By day, I mentioned to you earlier, I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if we can avoid the risk. When that's not an option, we look to see if we can minimize the risk. And if we're unable to avoid or nor minimize, we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. Could be, the lending environment, could be the political environment, could be just the general business environment, whatever it is that you identify and consider to be the biggest risk. And again, for clarification, while I'm an insurance broker, I'm not necessarily looking for an insurance-related answer. And so if you're willing, I'd like to ask you, Gregory Kovsky, what is the biggest risk?
I believe uncertainty in the economy is the biggest risk. I believe people can successfully play on the field when they know the environment. You can win a football game in the sun, the rain, the snow, if you can plan for it and develop a strategy to execute in that environment. And I believe the same is true in business. But like recently, when you're seeing tariffs change, when you're seeing COVID roll through the economy, when you're seeing high interest rates or different elements, changing tax environments in states that may make it more attractive or less attractive to be an entrepreneur. To me, those type of things makes it harder for people to commit capital, invest, and act in the economy. So then you end up with people on the sidelines waiting for more certainty to occur.
Yeah, no, I think there's a pretty good, recognition of that just in what we're seeing, and makes a lot of sense. Um, Gregory, where can the listeners go if they'd like to learn more or connect with you?
So I would first steer them to our website, which is ibainc.com. So Ice Cream Boy Apple, Ice Cream Nancy, Charlie.com. My mother was a school teacher and we lean into education. So within the website, I would gear them toward our blog, which has had over 200 guest authors, been published for over a decade, and everything you'd ever want to know about buying and selling a business or entrepreneurship probably has been covered. And then our video page posts podcasts like this, and yours will be shared there in the future, Darren, where people can gain knowledge, because I believe the best decisions are made from a foundation of knowledge. And then people can also call me at our corporate headquarters at 425-454-3052.
Awesome. Well, Gregory Kovsky, I cannot say thanks enough for taking the time to talk. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Thank you.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.